Hello, welcome to this week's Market Carver. I'm Andrew Thrasher, Senior Portfolio Manager, joined by Zach Unger, Portfolio Manager. We're going to talk about two major topics that are happening, one going on in the economy and one going on in the market, but tying into what's happening in the geopolitics right now. And that's actually where we're going to start. As you're probably aware, we have a lot going on over in the Middle East with the U.S. airstrike in Iran, and we're getting several questions about that, as we often do whenever we see big news stories coming, either internationally or anything kind of going on that could be impacting commodity markets like oil and things like that. And so we wanted to address that. And if you've watched the Market Carver for any period of time, you know what we often do is say we need to pause, step back, and look at the bigger picture and look at history to get a context so we're not acting overly emotional to whatever we're seeing in the headlines or news stories. And so that's where this first chart comes from and takes a step back and looks at the prior times we've had geopolitical shocks or wars or things like that happen, and what are the market reactions to them. So as you see here, we go all the way back to Pearl Harbor and listing out several other major events. And as you can see, the drawdowns aren't massive outside of really the Iraq invasion of Kuwait and Pearl Harbor, but we typically do see some type of drawdown depending on what kind of attack it is, whether like the Boston Marathon bombing you see there, Cuban Missile Crisis, the Tet Offensive, things like that. But the next chart I think is going to make a little bit more impactful. And this begins to look at, again, looking specifically at wars. If this does turn into a much larger conflict, that we can see that the annualized returns when we start looking longer periods actually still are positive. So that's what that blue line's on the chart there for World War II, Korean War, Vietnam, Gulf, Iraq, and then just general market returns since 1929. The market's averaged roughly about a 10% gain. That's important to recognize that even during these conflicts, we still saw the market able to produce in the long term a positive return. Now they're going to say, well, there's still going to be some volatility with that. And that's where we get that orange bar. That's looking at annualized standard deviation, which is just a fancy way of talking about the ups and downs of the market. And you can see those are elevated. We do see the market give some gyration during these periods as the market tries to figure out what is the ultimate impact to what's going on. And in this case, what's going on in the Middle East. And so we obviously see major impacts of that. We see defense stocks get impacted. We see companies that have a lot of global reach can be impacted. Obviously, commodity markets, we're seeing crude oil move higher. Fortunately, within the FEG models, we have had, prior to this occurring, increased our exposure to energy, to certain models, actually straight exposure to oil that's benefiting from that. And then looking at some of our sectors and pulling back a little bit from some of the tech exposure, we have actually had some action taken before this occurred. Obviously, not with any expectation that we would have an attack in Iran or anything going on there, but just based off what we're seeing in the market and what our data was telling us. Fortunately, those changes in positions actually were fortuitous to what we're seeing now. Now, of course, we're going to continue to see some market volatility as the market tries to figure out how long will this go on. But the main takeaway is this isn't the first shock we've seen. This isn't the first big headline involving the Middle East that we've seen, not even in the last 12 months. And the market has often digested these types of things pretty well. Again, we're always want to remember the market's more concerned with the profit potential of U.S. companies. And so far, we're not seeing direct impact there quite yet. Now, that could change. And if it does, we'll, of course, likely talk about it in the Market Carver. But right now, we do see this as being very focused on, again, what's going on in Iran, and then the impact to commodities is a direct exposure there. And so, again, we always want to not get too emotional to what we're seeing in the headlines, stay focused on the data, and that's exactly what our team's doing. Now I'm going to shift it over to Zach, who's going to continue to look, again, big picture, but now bring it back home to the labor market.
Yeah, the labor market is a critically important input both to the economy and to the market. On the economic side, the labor market drives consumer spending. The rationale is pretty intuitive. The more people that have jobs, the more money in the pocket, the more money the consumer spends, and that tends to help drive economic growth. And the opposite is also true, that when there are less people employed, you have less economic growth due to lower consumer spending. It's also important on the market front because it can impact profitability from companies if they have overhead from employees, and can impact market sentiment. Typically, when the labor market is not strong, the stock market responds poorly. Many have hypothesized over the past few years that as AI is introduced and adopted more by companies, that it would lead to job layoffs, that it would lead to a weaker labor market, particularly in the white collar space. And that hypothesis, particularly in AI exposed industries, is no longer a hypothesis. It's very, very real, as you can see on the chart, in the chart on your screen. That purple line there showing the AI exposed industries, you can see about in line with the launch of ChatGPT in 2022, has really started to taper off, and it's deviated from its pre-pandemic trend of moving up, while the non-AI exposed industries have continued to add jobs, even at the same pace or maybe even a bit quicker than pre-pandemic. And so what we're seeing right now is that the job losses due to AI exposure are really concentrated into a particular sub-market of the labor market. What we'll be looking for moving forward is if those job losses or those layoffs start to reverberate through the rest of the labor market and it starts to impact those non-AI exposed names. Obviously, if it does, we would expect some weakening of the continued weakening of the labor market that could flow through to the consumer, less money in the pockets, and could put a damper on economic growth moving forward. However, if it does stay contained to just those AI exposed names, we may not see the negative impact that many have expected.
Thank you, Zach. The labor market absolutely is one of the key inputs that we're watching for the economy as we get new data every month, definitely recognizing the impact that AI is having on different sub-industries there. If you do have any questions or you'd like to schedule an appointment, please reach out to us, either the website or the phone number on your screens, or scan that QR code. We thank you for your time and look forward to talking with you next week on the Market Carver.